Welcome back. For this video, we're going to talk about the second type of adjusting entry, which is converting liabilities to revenue. This should not take nearly as long as the first type because there's not really like multiple examples of this one. What this one is referring to is basically if a customer prepays for something that you have yet to deliver. The best example I think to explain this is concerts. Because if you buy a concert ticket, normally you're not doing that the day of the concert, right? You might do it a month, 2 months, 3 months before the event actually happens. So if you buy a ticket to something that's way in advance, that event center or whoever it is that's actually getting your money, they are getting your money, but they still owe you what you paid for, right? So on their side, it creates a liability, even though it's not technically a money related liability. It's more so that they owe you an like a either an experience or a piece of inventory or something else that you prepaid for, right? So the way that this will look when it's first recorded is pretty simple. So let's say that on March 1st, we have a customer that prepays for something, right? Something that we're going to do on June 1st, perhaps, if it's a concert, we'll say, or something else that happens on one specific day. So let's say that they give us $200 for this thing that's going to happen in the future. So we get $200 in our cash account. And normally, whenever a customer pays us, the second part of the entry would be a revenue going up, right? But since this is a revenue we have not yet earned, we're going to call it unearned revenue, this, which is technically a liability account. So if we were going to make a balance sheet right now, this is something you would see under the liability section of a balance sheet. Okay. And then whenever we actually deliver whatever it is this person bought, then we could undo the liability by debiting it. And then at this point, we can actually call it earned revenue or just revenue. Okay. So, where this comes in as far as adjusting entries go, because this isn't technically an adjusting entry, right? It's just we're waiting until the person actually, gets what they paid for and then we're reversing it. Let's say that instead of March 1st, let's say that this was November 1st. And let's say that a person prepaid for something that they are going to get over time, maybe. Like, let's say that they prepaid for 3 months of work that we're going to do for them, and they're going to pay us $1,000 a month. All right. So, since this is happening on November 1st, we're going to kind of assume that the 3 months are November, December, and January. Okay. So, the last day that we're actually going to be working for whatever this is January 31st. So this person is going to give us $3,000 on November 1st for work to be done over the next 3 months. So on December 31st, though, this is where we would need an adjusting entry. Because if we were going to make annual financial statements on that day, the problem is we've technically earned 2 months of that. We normally would wait till everything's done before we go ahead and reverse it and say, okay, now instead of unearned revenue, it's earned revenue now. But since the end of the year happened in between those 2 days, we have to make sure that the revenue we earned in November and December stays in that year, and the revenue we earn in January goes into the next year, right? So, what we're going to do is go ahead and reverse basically the amount that happened in the current year. So, we're going to do this. It would be $2,000, right? Because they're doing $1,000 a month. 2 months have passed. So we've shown that we've technically earned 2,000, and you know the unearned revenue has went down by 2,000. So we still owe them $1,000 worth of work, right? But by doing this, we can make sure that the revenue stays on the income statement for this current year. It doesn't get put in the next year. right? Because then we wouldn't be lining up when we actually earned the revenue, right? Remember, accrual accounting, we're trying to make sure everything lines up in the time period it actually happened in. And then on January 31st, we could go ahead and do the other part that is now the amount that's fully been earned now, right? We could do this. Okay. So that is what an adjusting entry would look like for unearned revenue. I'll go ahead and stop the video there.